some of the concerns surrounding the job market, not in this report so much today, but concerns that thousands of fired federal workers could really change the trajectory of growth in the labor market. How would that change the Fed's view when it comes to interest rates?
Well, it would be an interesting question because it would depend on how serious it is. Federal workers, all of them, about 2 million of them make up about 1.5% of the total labor force. So if several hundred thousand lose their job, it isn't going to make a big difference. It could bleed over into other sectors, though, as people whose jobs are built around these federal government workers, restaurants or stores or things like that. If people lose their jobs, we could see an expansion. And obviously, the contractors, the civilian contractors who do work for the federal government could lose their jobs. Now, if that starts to spread, then you get perhaps a psychological effect on the rest of consumers who start to worry about their jobs, and then they pull back on spending. And that's the classic way a recession starts.
Well, and wouldn't that suggest, Mike, that while everybody's, to Joe's point on the dual mandate, trying to focus on the inflationary side, and that's preliminary or primarily what the Fed has been keying off of too, that actually the growth risks might be greater or just as great as the inflation risks right now, as we are seeing that consumer pullback potentially that you're talking about, that could be further fuel.
Well, the problem for the Fed is they're caught in the middle here, and they're very happy with the fact that right now inflation's coming down slowly, but coming down, and the labor market is solid. The problem is if the labor market deteriorates a lot, that's a suggestion that we're going to see growth fall off, and then you start to worry about recession, and then you start thinking about cutting interest rates. If inflation rises, then they would have to start thinking about raising interest rates, which would also probably lead you into recession. So they'd be caught between a rock and a hard place. So they don't have a lot of good policy choices if this all goes pear-shaped. And there is a genuine consensus, I think, at the Fed and among people on Wall Street that President Trump has a very, very narrow path to make this work.
As we consider what Mike was just talking about, tariffs, this is actually something that our colleague, Jonathan Farrow, had the chance to speak with the National Economic Council Director, Kevin Hassett, about earlier this morning, as once again, we're getting new headlines from President Trump around tariffs he may or may not impose on partners like Canada. This is how Director Hassett spoke about it.
I think in some sense that you've got quite a bit of clarity already. There's no uncertainty. There's going to be some tariff that's going to be reciprocal. If you don't like tariffs very much, then reciprocal could be a great thing for you because then countries around the world will be lowering their tariffs. But the president believes that if we replace income tax revenue with tariff revenue, it can make everybody better off.
Make everybody better off, Joe.
Mm-hmm.
Of course, not all economists are privy to that same view.
No, and it brings us back to this idea of short-term pain, this adjustment.
Back in the bear. We're back in the bear.
That would be great.
Yeah, so we need this candle right here. You need to set off. We need this right here to take out. We need the next cans. So right now, basically next.
This idea of a short-term correction has yet to be quantified.
Well, yes.
We need to lose it right here. We're this on by here. So we need it down here. So 570. Oh my God.
The levels where they were on today after we found out Trump, who was leader now the Nasdaq 100 earlier today, as you mentioned, Joe, fell into correction territory. So it's not clear whether we're going to end the trading the day there. Well, to your point on mortgage rates, we have seen them come down as we've seen bond yields falling specifically. And this administration has contended, Kitty, that they don't necessarily need the Fed to be cutting interest rates, that there are mechanisms through which they can actually bring rates down on their own and still have that relief provided to wannabe home buyers or people who need to borrow money that you're alluding to. Are there actual fiscal means with which they can do that in your mind?
I mean, the government has a lot of power to make homes more affordable, but I don't think anything the Trump administration is planning gets at that core issue for the American people. There are lots of things that the government can do to bring down the prices of healthcare and groceries and the things that Americans rely on. And the Trump administration is moving in the opposite direction. So I wouldn't take those promises at face value.